Good afternoon, everyone. Welcome to Equitas Holdings Limited Q4 FY18 earnings call. During Q4, the operations of the bank progressed well. Total advances as of March 18 stood at 8,238 crores, registering a growth of over 15%, led by a strong growth in our non-MFI portfolio, which grew by 53% year-on-year. The PAT for the quarter was 34.9 crores as we returned to profitability. Annualized ROA for the quarter was at 1.12%. PAT for the full year came in at 31.4 crores, and we managed to remain profitable despite high credit costs and the resultant planned slowdown in microfinance business. Now I hand over the call to P.N. Vasudevan to take you through the performances for the quarter.
Thank you, Bhaskar. Good evening to all of you, and thank you for dialing into our call. In the December 17 quarter, we had made full provision for all the impacted microfinance advance, which arose due to the demonetization. Effectively, the March 18 quarter is the first quarter without the overhang of the impacted portfolio. The advances as of March 18 was about 8,200 crore, which is a 15% growth over the previous year. Within this advance, the non-microfinance book constitutes about 72% of the portfolio, and this part of the book recorded a growth of around 53% over the previous year. The microfinance book, which is the remaining 28%, degrew by about 30% over the previous year, which is part of our conscious strategy of de-risking the portfolio. In terms of NPA, the overall GNPA reduced from 4.95 to 2.72% in March, and within this, the non-microfinance NPA reduced from 4.1 to 3.4% in March. As far as the microfinance is concerned, the GNPA reduced from 6.8 to around 0.75%, largely due to the return of the impacted portfolio during this quarter. And at this level of around 0.75% GNPA, the microfinance book is now reflecting the normal levels of delinquency, which is traditionally associated with this product. Our branch network is also fairly in place with about 375 branches on liabilities and nearly 500 branches on the asset side. Except for some strategic branches we may put up, there is no serious ramp-up of branches envisaged this year. This year, the aim would be significantly to leverage the existing infrastructure that we have already invested in. On deposits, we continue to show good traction with total deposits moving to about 4,700 crores, which is about 45% of our total borrowings. Within this, the CASA ratio has moved up to 34%. And the fee income from liabilities has also shown good traction over the previous quarter. To sum up, the GNPA of the various products are within comfortable levels, giving us the bandwidth to pursue growth. The new products introduced in the previous year have also shown a good traction. The working capital products are expected to be rolled out by the second quarter, and over the course of the current year should be available across all the branches. Microfinance this year is expected to grow, albeit at a smaller rate of around 15-20%, while the non-microfinance portfolio should continue to record a strong growth. On the overall, we expect this year that the advances should grow probably by around 35% plus. With this, I would like to hand over to the operator, and we'll be happy to take any questions from your end. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah, congratulations, sir, for good traction across all the operating metrics. So, particularly in terms of growth, so as you have been guiding for the MFI has also come off to 28%. But now when we look at in terms of the size, vehicle plus, say, LAP as well as MFI, those are around 2,200 odd crores. Which other segment do we see could gain scale to a similar extent, be it in terms of housing finance or business loans? So apart from these three segments, which would be the other key focus product segment which could scale up significantly?
See, over the next couple of years, we expect our MSE loans to really come up strongly, because when I say MSE, we are really talking of business loans, working capital loans, and term loans for the small and micro and small enterprises. The loan sizes typically should be in the range of around 10 lakhs to 50 lakhs and maybe 50 lakhs to 1 crore. With an average loan size maybe anywhere in the range of 30, 40, 50 lakhs. So that is a segment that we are looking at as a significant opportunity, because the demand again from that profile of customer and that segment is really very large. And again, the supply of money or supply of facilities from the rest of the banking sector is not very high in that segment. So going forward, microfinance may be a decent part of the book. Commercial vehicle should continue to be a good size of the book. The micro lab, which has been something we have done in the last 6 years or so, and where we have built in, a tremendous amount of capability to underwrite the credit based on our own, cash flow assessment, and also manage the collections. That should again continue to be a strong part of the book. And the latest addition, which could be our MSE funding, which we have just launched and which should be rolled out into all the branches by this year, that could be principally the fourth biggest product as we go forward.
Yeah, so would LAP also go at maybe the overall average asset growth of more than 35%?
Come again?
Would LAP also grow at, say, the average asset growth of more than 35%, or now maybe we have seen it scaling up to some level and it should follow the overall balance sheet growth? So
no, see, our LAP is different from the LAP that generally the market talks of. Our LAP is really the micro LAP, which is the very small size and, the less than 5 lakh and the less than 10 lakh kind of loans.
Yeah.
And the demand again in that segment continues to be quite strong, really strong, and the supply continues to be quite small. So the percentage growth rate and all that should continue to be good, because our own size also is very small. Our base is still very small at 2,200 crores. Our LAP book is still really quite small compared to the kind of demand that's there in the market. And so long as we are able to maintain our portfolio quality intact and so long as our collection remains strong, the micro LAP also should continue to exhibit a good traction over the next maybe 3 years or so.
Okay. And in terms of asset centers, those have come up from 620 to 597. So what would be the reason for that? And that too particularly in Tamil Nadu is where we had seen. So what's the reason for that? Is it consolidation or how should we look?
Yeah. There are some places where we had offices in the same town, different asset offices. So all of them have been rationalized and brought into under one roof. That's the reason.
Okay. And lastly, in terms of retail TD, so CASA is gaining significant traction, but if we look at retail TD in terms of the number of customers, so that's still broadly the same. So is it maybe the growth which is coming in on the term deposit side that is largely the bulk deposit and equivalent traction is not being seen on the retail TD because number of customers are almost similar?
Yeah. I'll ask Sanjeev to respond on that.
Yeah. Thanks, Vasu. So actually, if you look at it, we realized it, and we have interest rate which is, below 10 lakh 6% and about 10 lakh 6.5% interest rate is pretty much comparable to the retail TD of other banks. So, but however, we do want, sustainable money on retail TD side, and therefore we are just tweaking our interest rate, in this financial year. And because we have realized that it is important, retail TD is an important, side, so we're just tweaking our interest rate to make it more attractive, and we really want our entire retail distribution franchise to garner good retail deposit, which is a long-term sustainable money. So we are working on that.
Okay, so now there should be an uptick out there.
Yeah, sure.
Okay, yeah, thanks a lot and all the best.
Thank you.
Thank you. The next question is on the line of Amit J. from UTI Mutual Funds. Please go ahead.
Good evening, sir, and thanks for the opportunity. Just if you can guide us, what led to a lower operating expense, both on the employee as well as on the other expense front this quarter on a quarter-on-quarter basis? Hello?
Excuse me, sir.
Yeah. See, on the OPEX, if you compare on the quarter-on-quarter Q3 versus Q4, on the employee cost, we had a reduction of nearly 11 crores. That is basically arising out of actual valuation difference. Otherwise, rest of the OPEX expenses remain the same almost actually. What is that?
No, even the other expenses are down. Is there any one of there? What is the sustainable cost-income ratio, say, for next year? Or at 200 odd crore is the sustainable quarterly OPEX, or it should be around 250 crores? So what is the range, broader range for the next year?
So, our cost should go up this year compared to the last year, basically because of one, of course, the increment salary changes and increments that will be given out in the month of April. And then the traditional increase in the operating expense such as rental, which happens on a yearly basis. So these two are anyway something that we have to factor in. Beyond this, from an expansion perspective, as I had mentioned earlier, we do not expect too many branches to be added. Of course, there will be a few branches strategically placed from, which will be opened in a few locations. But otherwise, no significant branch expansion is planned for the current year. And from a staff perspective, again, there would be some increase in staff, especially in terms of maybe credit and collections in some of the new products. But otherwise, we do not expect significant increase in the number of staff either. So, more or less, minus the normal, yearly changes in the operating expense, we should expect to see a reasonable amount of stability in terms of our operating expense.
And in terms of trajectory of the cost income as well as the ROA matrices, where do you see them moving into FY19? If you can give the guidance.
Well, we are not really going to give any particular number as a guidance on these factors, except that you can see there is a decrease in the cost income from third to fourth quarter. And as I had mentioned earlier, there is the operating cost is expected to stabilize in the current year with the changes that I had already mentioned, with certain level of increase which I had just mentioned. And the portfolio growth should continue. There we did put in a guidance out when I spoke that, we do expect the portfolio to grow around 35% plus during the current year. So I think that's the guidance we are giving, and from there we should be able to work out, reasonably how the ROA should look like.
And last question, sir, in terms of PSLC fees, what could be the amount, say, next year? And was there any GST provision related to PSLC as some of the other banks had to make?
See, PSLC income we cannot predict because it's a purely market demand supply-led issue. So we'll take it as it comes. Maybe sometime in the month of June, when the PSLC demand picks up, we'll have to see how much we are able to, how much kitty we have to sell first of all, and what kind of rates go around in the market. So it's not possible to predict that. In terms of GST on PSLC, it's very clear. I think there's been a lot of clarifications issued that GST would apply. So whenever we do a PSLC deal, as per the current rules and regulations, I believe that we are expected to provide for GST.
And what is the rate of GST in that?
It's the same standard rate, 18%.
Okay. Thank you, sir. That's it from my side.
Okay. Thank you, Amit. Bye-bye.
Thank you. The next question is on the line of Rice William from Altera Capital. Please go ahead.
Hi, everyone. Thank you for taking my question. It's just on, I wanted to ask you about treasury management, as we saw another quite considerable increase in the security portfolio this quarter that was fully funded by a proportional increase in the wholesale borrowing book. We've now seen advances on balance sheet as a percentage of total assets dropping to a level of just 58%, which is obviously dragging down your NIMs while your loan spreads have remained pretty strong. So I just wanted to understand what the reason was for taking on all of this extra liquidity in the quarter, and how we should expect the balance sheet to look in the coming quarters as you ramp up your loan growth.
Yeah. See, we are sitting on a fairly high capital adequacy. So while the advances will grow and hopefully over the next few years the capital will get consumed by the growth in advances. So this one, what we did and what we expect to do is basically to see how do we leverage our excess capital to increase the overall earnings for the bank. So the Treasury did undertake some short-term borrowings and also use that money for investing in short-term assets, which gives us a certain level of yield. Of course, it's not anywhere comparable to the yield on our advances naturally, but it's still an yield. And it helps us leverage the capital and increases the earnings overall for the bank. Some of the ratios would look weaker because of that, like the NIM will look a little weaker maybe. The ROA may probably also look a little weaker because you are having a larger denominator to deal with. But your ROE should be looking better because your overall earnings is going up on the same capital. So we will continue to do this kind of short-term treasury borrowing and investment so long as they give us a positive yield and so long as there is a capital which is more than what is required for the advances. So I think that's the whole strategy on the treasury piece.
Okay, thank you. Could you put a little bit of a few numbers around where you're seeing your marginal borrowing cost for short-term wholesale funding and what kind of yields you're reinvesting that at? So what sort of spreads you're earning on these marginal treasury transactions?
William, Dheeraj here. So the treasury, when they look at an arbitrage opportunity, roughly it's about 60 to 80 basis points is the spread where they look in and lock in the transaction, both SLR and non-SLR.
Okay, great. Thank you. Thanks, guys.
Thank you. The next question is from the line of Asim Pant from HSBC. Please go ahead.
Yeah, hi, sir. Thank you for taking my question. Just a couple of questions. One is, in terms of your PSL, qualifying book, what would that be right now as a percentage of your total ANBC?
Those are numbers which is very difficult to put it out in public space, Asim.
Okay. No problem, sir. And secondly, sir, just coming back to the microfinance kind of scenario, I mean, 2 years, almost, 1.5 years have passed since demonetization and the whole upheaval. How are these, what is the ground level experience now in terms of competitive intensity, many players, is it, how has the scene changed between then and now, or has it not changed, and especially with the ticket size, that MFIN has increased the ticket size that is allowable to lend to a customer. How do you see all this playing out, in terms of risks and opportunities?
Yeah, hi, this is Raghavan. In terms of microfinance post demonetization till September 2017, there was turbulence. Post September 17 onwards, there was a lot of calmness in the marketplace, and the clients have also started realizing that, it was no more a savior. So the situation at the ground was that the microfinance institutions and bank was able to go back to the clients, touch base with the clients and regularize certain, repayments. right? And then second, in terms of the competition, I think microfinance still, offers you a very large opportunity. The penetration levels are still low. And second, most important thing is that it's a 2-year tenure. So the tenure is so small so that always you'll have enough people, enough clients out there to go and then lend. In terms of MFIN, it has not increased the ticket size. It has increased the credit limit, the outstanding from 60,000 to 80,000, right? So to that extent, I think because now, as per MFIN also guidance, the 2-3 institutions can actually lend, right? So that's the reason why from 60,000 it was raised to 80,000. But otherwise, ticket sizes, post a demon, I think most of the institutions have tapered down the ticket sizes, and they're under, reasonable level as of now.
Okay, sir. Thank you. And so one last question. In terms of your spread outlook for FY19, what would that be from here on?
So the spreads, what we have seen in Q4 is 11.3%. So we think it will hold on to this levels for the year because we also have some of our high-cost debt maturing in FY18. So that, along with even if we have reasonable traction in our low-yield products, we should hold to this spread of 11.3.
Okay. Okay, thank you so much and wish you all the very best.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. So on vehicle finance, we have witnessed relatively slower growth versus our non-microfinance book growth of 53%. While there's a lot of optimism in CV vehicle finance, and if we look at the growth of peers, they have been growing at a very healthy pace. So any particular reason of our growth being slower?
Yeah, our commercial vehicle finance actually grew by around 20% over the previous year. And there's no particular reason our book continues to be good, but, during the year, somewhere in the middle of the year, we did slow down a bit on our growth in commercial vehicle when especially the month of July, August, if you remember, our second quarter was not very good from an NPA perspective. Our July, August was in fact one of our lowest collection efficiency months, which we thought was attributed largely to the GST rollout. But subsequently from September onwards, the portfolio and the collection came back quite strongly. And of course, the year ended very, very comfortably in terms of our NPA. And so that was one reason why we kind of took a little bit of a slowdown on the vehicles in the middle of the year. But now the growth is completely back on track, and the commercial vehicle market is also expected to do well this year from the overall perspective. And the new vehicle sales has also been increasing. We did introduce a new LCV financing in the middle of last year. So that also should add to the growth from the overall commercial vehicle segment. So this was the reason why we had about a 20% growth last year. And this year the market looks good. So we'll have to see how well the commercial vehicle picks up.
And on the asset quality, thanks for giving the disclosure on the line of business basis. There is slight increase in gross NPA in mortgage segment as well as the 1% gross NPA of business loans. How one should look at, because on a base of last year, that percentage may look pretty high. So just comment on these two line items.
Yeah, Badresh Phatak. On the business loans, 1% NPA is over a portfolio of about 411 crores created over a period of 1 year. We are consciously taking very quality cases from the market, and going forward, it is not going to increase beyond this. With this asset quality, I think the kind of rates that we are charging, we are comfortable as far as the business loans are concerned.
And on the mortgages, there's a small increase, but that's quite under control, actually.
And lastly, on the operating expense, what sort of growth we should expect from these levels? Should it be single digit or 10% or 15% plus?
I think we went through that in the last two questions. We have gone through that. So you'll have to stitch in some increase for the salary increments. You'll have to stitch in some increase for normal admin expenses like rental, etc. And some little bit of increase for new staff, especially for the new products that we'll be recruiting. Otherwise, principally, our branch expansion is not expected to be very high. Mostly, we'll be leveraging the current branch network for the current year. So I think that's what you'll have to factor in when we look at our growth in operating expense.
Because last time you guided for a 15% plus growth in OPEX. Whether that's a reasonable estimate or we should...
Yeah, I mean, that's a reasonable estimate, I would believe.
Oh, okay, sir. Thank you, sir. Thank you.
Thanks, Bobby.
Thank you. We'll take the next question from the line of Manish Ostwal from Nirmal Bang. Please go ahead.
Yes, sir. Thank you for the opportunity, sir. I have a question on...
Sorry to interrupt, Mr. Ostwal. Sir, can you speak a bit louder? We're not able to hear you.
Hello?
Sir,
hello?
Yeah, we can hear you.
Sir, the line for the current participant has dropped off the queue. We'll move on to the next question. That is on the line of Madhu Chanda De from MCA Research. Please go ahead.
Hello. Yeah, hello. Am I audible? Hello?
Yeah.
Yeah. My question is, you just mentioned that you don't plan to incur more expenditure on adding branch network. Okay. And we have seen decent traction in deposits this year. So in light of this, should we expect similar traction in deposits in FY19? Or what is your take on that?
Yeah, because see, many of our branches are still fairly young, and so the deposit traction should continue to be good because basically the branches are not really matured. And I would also request my colleague Sanjeev to talk further on that.
Yeah, so I think from the CASA perspective, we are going to have a three-pronged strategy. Our penetration into mass market is fairly stabilizing. We'll continue to focus on that. Then we have just entered in Q3 through our product like Wings account or savings plan, which is basically our entry into the mass affluent segment, and we are happy to share that in our 100-odd days of journey on Wings account, we were able to add close to about 25,000 Wings customers with a savings balance sheet of about 342 crore. With an increased ATS of about 1.3 lakhs. So this year, the full year, this product will be available. Also on the current account side, we are adding some products with a higher variant. So we will focus on that. And our third pronged strategy will be to leverage our MSE network and then completing the 360-degree banking, offering the entire solution for the family, both on liabilities as well as asset side. So we are very hopeful that, we will see even higher traction on CASA build-up across the branches.
No, as a proportion, which is now 45% at the end of FY18, where do you think it should settle by end of FY19, the total deposits?
And take a look in the last year, which has gone by, we have added close to about 2,800 crore of liabilities, out of which our CASA has been 42% and liabilities have been 54%. So similarly, what we anticipate is that currently we're at about 35%. We expect it to be somewhere around in the band of 37 to 38%.
And in terms of deposit as a percentage of total borrowing, in March we were 45% of the total borrowing from deposit. And next year, because of some of the scheduled repayments of the grandfathered loans and the NCDs, etc., that 45% should reach around 70%, based on the repayment of some of the grandfathered borrowings.
Okay.
Thank you.
And sorry, just one small question if I can ask you. Hello?
Yes,
in light of whatever you have guided for your advances growth, which is to the tune of 35%, now the credit cost normalization should happen. So what kind of ROA are you, looking at in FY19?
We are not really guiding on that at this point in time.
And are you guiding on your credit cost for FY19?
Not really. But we can say overall that, we don't normally give guidance on anything except our advance growth. But if you see our credit cost, it's around 2.5% in the last year. And current year, you should be able to look at some improvement on that because basically the overhang of the demon thing is all kind of behind us. And we should be looking at more normal levels of credit cost. And our opening NPA is 2.72%. So that's where the credit cost is going to come out of. You should be able to factor in based on that. But other than the advance growth, we are actually not guiding on anything else directly.
Okay. Thanks and all the best.
Thank you. Bye-bye.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bank. Please go ahead.
Yes, sir. My question on this asset mix strategy. Sir, we have a universal bank called Bandhan Bank, and they are doing extremely well in MF business. Secondly, one of the leading bank also ventured big way in MF business, but the management of Equitas believes unsecured MF should be reduced 10% by over the next few years. Why we are believing this business overall, that overall risk return trade-off is not superior, and we have been doing this business with a reasonable time frame also. So why we believe this business not good for us?
Well, that's a difficult question to answer because you're trying to ask me what is the rationale of some of my competitors of which I actually frankly have no idea at all. So I will not be able to comment anything about what someone else is saying or doing. All I can say only is from our own perspective. We started microfinance in 2007 and, not just in India but globally we are regarded as one of the most efficient microfinance provider. And our operating efficiency, our operating process controls and our ability to leverage technology, everything is regarded as amongst the best globally in terms of the microfinance operations. And as I mentioned earlier, we have a current GNP of around 0.75% in microfinance, which is more or less the normal standard levels of NP associated with microfinance as a product. But now, so in terms of our risk assessment, in terms of our portfolio mix, etc., I think that's largely a very individualized decision making that each organization does as to, which segment you want to be in and which segment you want to have a presence and what kind of a distribution you want on your various products. I think it's significantly a decision taken by institutions, which is very much closer to what they believe from a risk return perspective. So beyond that, it's very difficult for me to tell you what percentage is right and what percentage is wrong and things like that. I mean, if someone else has a strategy which seems to be different from us, I won't be able to really comment beyond that.
Appreciate, sir. Add on to this is the risk-adjusted return on asset with respect to our asset loan mix and resulted overall ROE given the balance sheet leverage. Will it be significantly different? Because since we are moving into secured business, our overall expected credit cost and will be much lower than the unsecured business. So overall risk-adjusted ROE, how it will be different from the earlier asset mix business?
See, I think that's something we have mentioned in our earlier presentations in the previous quarters also in terms of what over a period of time, when I say over a period of time, over a period of a few years, what kind of a typical, ROAs and ROAs should be expected from a portfolio of this kind? I think we have kind of given that in our previous presentations, which is approximately something like an ROA of 2 to 2.5% and a ROE of anywhere around 16 to 18%. So that's the kind of steady state ROAs and ROEs one should expect from a small finance bank which operates on the liability side by mobilizing deposit, and on the lending side typically is distributed across the kind of products that typical opportunity presents for SOPs.
Sure, sir. A second question on the operating expenses side, you said the ROA of 2.5% steady state. So in terms of operating expenses, what is the steady state cost-to-income ratio for Equitas?
See, again, that will be very specific to each institution, your cost-to-income. For example, in our case, it is 76% as of March 18. And on a steady state basis, give us a couple of years' time and strong growth, assuming that we are able to produce a strong growth on our advances, etc. I think our cost income may still be at a level which is higher than most of the traditional banks. So it could still be in the range of 60% plus, because that's the kind of operating model that we operate in. The operating expense would be on the higher side since our ticket sizes are expected to continue to remain very small. And so the management cost of both credit cash flow assessment, credit assessment, and collection should continue to remain high. Of course, the yield will remain proportionately higher than traditional banks, but so will your operating cost be compared to the traditional banks. So I think on a steady state basis, maybe you can say 60% plus could be a level where it can stabilize for someone like us.
And sir, in terms of balance sheet leverage, currently we have very strong capital position. So what kind of leverage we can see next couple of years, and whether the current capital is more than sufficient for next 3 years balance sheet growth, or how do you assess that?
Yeah, we have quite a strong capital base right now. So the whole objective will be to leverage it over the next maybe 2 or 3 years. We are still not having much tier 2 also. So once we kind of exhaust our tier 1 capital, maybe over the next 2 or 3 year period, we still have an opportunity to look at any possible tier 2 bonds and and stretch the capital to that extent. So those are decisions that will have to be taken as as the situation comes up. But clearly, yes, the objective is to leverage the current capital over the next 2 to 3 years time.
And lastly, one small data point: what is the rate currently we offer on the MF loan, microfinance loan?
It's 23%.
23%. Thank you, sir. Thank you.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Yes, it has been almost 1.5 years since you transitioned into a bank, and looking into next 3 years, you are guiding for a 2.25% sort of ROA. What is the biggest challenge or risk to this number in your view over the next 3 years?
See, the biggest challenge for a model like ours in terms of reaching a steady state, operating metrics would be the quality of our book. So that will be the biggest challenge. See, on the liabilities, our challenge will continue to remain in terms of mopping up and mobilizing deposits. But even if my cost of deposit is 0.5% more than what we expect or something like that, it is not going to dramatically impact my operating metrics, because we operate in markets where the demand continues to remain very strong and the supply continues to remain very weak. So growth per se is something that we can pursue, but clearly the challenges of managing a book largely comprising of people from the informal economy to the tiny, micro and small enterprise segment, that is going to be the challenge. And it's not an easy challenge. There is a lot of challenge in that. The reason why there is not enough supply of loans, money to that segment is obvious. And so those challenges remain, and our ability to manage the challenge and manage to retain a very strong quality of our book. I think that is the single biggest factor which we should be constantly focusing and monitoring, as we try to move the bank over the next 3 years.
Sure, sir. Thank you, sir. Thank you.
Thank you, Nitish.
Thank you. The next question is from the line of Sohail Halai from Systematic Shares and Stock. Please go ahead.
Good evening, sir. So just wanted to check about what is the yields that we are offering on the business loans and the corporate loans?
See, business loans, there are two types. One is the secured, the other is the unsecured. The secured goes at anywhere around 10.5, 11, 12 to maybe 13, 14, depending on the type of customer and the quantum of loan, etc.
Okay.
Your business loan typically goes in the range of around 16 to 18 to 19%, again depending on the type of customer background as well as the quantum of loan.
Okay, and so corporate loans?
Corporate loan, of course, is a very small book, and when I say corporate, I don't really mean corporate. We really mean something like a small to mid-corporate, and largely that also is institution funding. So the rates there, if it's institution funding, then the rates could be around 10% to 10.5% or something in that range. For the small to medium corporates, again, depending on the rating, if they do have a rating at all, and depending on the financials and size, etc., the rates can vary around 10.5, 11 to 12 probably.
Okay. And so in terms of business loan, how much of the book would be currently secured and how much would be unsecured?
The 411 crores is the unsecured book, and approximately around 200 crores would be the secured business loan.
Okay. So, sir, as we see this proportion going up in the coming quarters, what kind of pressure can it actually draw down on our yields? And secondly, in terms of debentures that we have around 1,700 crores odd, what will be the rate on that, and how long will it take to maturity? So, for example, in FY19, how much of them will get matured?
I already mentioned that our deposit forms 45% of the total borrowings as of March 18, and by March 19, based on some of the scheduled repayment of our grandfathered loans, the deposit should move up to around 70%. So that's the expectation in terms of deposit and grandfathered loans. And on the yield, you are saying, the yield on advances should come down because of the introduction of the lower yielding products. Naturally, it should come down. Whether the margin will also come down is something that obviously we'll be working very hard to try and see where, to retain it where it is currently.
Okay. So I was talking in terms of debentures, non-NCDs, around 1,700 odd. They all will get matured in FY19?
No, actually it will be 2 years. The current year it will be 1,100 crores, and the next year it will be 633 crores.
And so the interest that we are paying on that would be something 11.25, right?
Around 11 to 11.
Okay. And so lastly, in terms of PSL, how much of a book qualifies for PSL?
See, we have to have 75% of PSL target that we have to meet.
Yes.
Yeah.
So currently, how much of the book qualifies for PSL?
See, those are data that we would not want to put out in public space.
So this is in respect to, just to gauge in terms of what is the kind of fees that you can earn from PSLC, because
I know,
what is kind of a cushion that is there?
An information that we'll be very uncomfortable putting out in public space.
Okay. So, sir, let me put it another round. So, can we expect decent PSLC fees next year, or are we actually expecting it to be in low 20-30 kind of crores odd?
Why don't you ask me a few more specific questions like that? So, you'll have to just wait. At the end of this quarter, we'll tell you how much we made.
Sure, sir. Thanks a lot, sir.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Sir, I believe I missed, you mentioned something about the ticket size in this new vertical, small and mid corporate loan. So what is the broad ticket size there, sir?
The ticket size there today is around 15 crores, but that is also including some of the institutional funding that we do. So it includes that. And the average currently for that division is around 15 crores.
Okay, and what would be the broad range, sir? I mean, roughly, or maybe now and your vision of, how this vertical would have the ticket size in terms of range?
See, normally that division won't do less than 5 crores because that will be done by the MSC division. On the higher side, of course, we have the regulatory cap for 10% of the net worth and all that. But internally, we have some risk, limits put in by our internal risk team. So those are very internal information, difficult to give you that publicly.
Sure. And sir, secondly, on vehicle finance, first, sir, we are having a gross NPA ratio of around 4.9% there. So first, I wanted to understand how do you see that ratio going ahead in FY19, considering there's some positive business momentum for both CV players as well as CV financiers? And secondly, what would be the rough proportion of used CV and new CV there?
Yeah, the NPA should hopefully remain steady for the current year because it's come down well. It's come down quite well over the previous year. So we hope to hold it steady for the current year. And the markets are doing very well. The commercial vehicle market is doing well. Our own collection experience in the last 3, 4, 5 months continuously has been very strong. So we do expect the portfolio to retain its quality going forward. And in terms of the mix of used and new, the new will be still a very small percentage. I think the new will be probably less than 5% of the total book within the commercial vehicle space. But this year the new should go up from 5% as the traction builds up on that.
Sure, sir. And just last one data point, sir. If you can share the cost of our SAR deposit on a blended basis.
Sorry, come again?
Sir, the cost of savings deposit on blended basis.
In slide 20, we have given this ratio, the cost of deposit, 6.5 is Q4, FY18.
Correct. So this is for full deposit. If you can share the cost of SAR deposit only.
SAR? Yeah. SAR, so we are paying 6% up to 10 lakhs and 6.5 about 10 lakh balances.
So on a blended basis, it would be somewhere around 6.3%.
Sure.
Largely, coming out of below 10 lakh and about 10 lakh. We don't have any other third rate which we offer as of now.
Sure, sir. That's very helpful. Thank you.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Good afternoon, sir. Just 4 questions from my end. One, and I know this question has been repeated from my side last time as well. On the MFI business, just wanted to understand, A, what is the average ticket size as we speak today? And 2, when we go to the market, we continue to see a fair amount of reluctance on Equitas MFI, where they have not increased the ticket size as compared to the rest of the players. Just wanted to understand where are we on the MFI business and how profitable is this book going to be if you continue to keep a very low ticket size in the MFI business, because incrementally you will start losing customers in the second and third leg quite steeply as compared to the rest of the players. A question to Vasu. You had indicated that you would want to move a fair amount of your MFI customer base into the individual lending side. We've passed through a year. Just trying to understand how has been the experience on those customers who have moved into the non-MFI bucket. Third question is on your the interest rate risk that you're... that is a sub-question there. The third question is on the interest rate risk. Are you taking anything on the incremental liquidity management that you're doing? Any interest rate risk that you're taking on that front?
Okay, this is Raghavan here, and you have been consistently asking the question since last quarter, and I'm consistently telling in terms of our approach as far as microfinance ticket size are concerned. The average ticket size today is around 22,000, including a mix of first cycle, second cycle, and third cycle put together. We have a very strong belief that microfinance as a product itself is an unsecured loan, where there is no credit assessment done of the clients. So hence, you have to err on the right side always. So we're very clear that, in terms of ticket size of the last 3-4 years, we have been very prudent in terms of increasing the ticket size. While the market has gone up and then increased, that's left to them. And we continue to be cautious on the microfinance, and the ticket sizes will be going only based on some logic, which we'll have to define. Number two, in terms of the second question was about opportunity, right? Because are we losing out in terms of opportunity because we are not raising the ticket size? I think since last 4 to 5 years, when competitors were offering 50,000, we were offering only 25,000 rupees. But the market is too large, and the penetration is, definitely still a long way to go. Hence, as long as the market is able to consume our ticket size, we shouldn't face any problems. So that's a stand that we take. And third question was?
No, just kind of highlighting that part. Is the portfolio going to be as profitable as what you see in some of the other players? Because the challenge is that if your ticket sizes are low, the OPEX for running such a low ticket size is going to be materially higher, right?
No, it's not the question of ticket size. It's a question of efficiency and productivity. See, if you look at the per staff productivity, we are almost all 2.5 times of any other near competitor. So to an extent, even that mitigates my lower ticket size. So hence, it should not impact the profitability at all and operating costs thereby.
And the transition from MFI customers to individual side, you indicated that there's an outside possibility of around 10 to 15% that you can move to individual loans.
Correct.
Where are you on that?
Okay. Currently, if you look at it, close to 45% of the loans that we are disbursed belongs to our microfinance clients. So that's the kind of a potential that we have. And the portfolio quality is extremely good. The NPA is around 1.1%.
Okay. And the interest rate risk?
And on the interest rates on treasury, it's slightly managed. We are not taking interest rate risk on that.
It's a match duration, the portfolio that you're taking.
Totally.
Okay. Thanks a lot.
Thank you.
Thank you. We'll take the next question from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Congrats. Most of the questions have been answered. Just what's the geographical distribution of the non-micro portfolio? Broadly.
If you go to page 17, have we given something on that? Geography. Okay, in terms of geography, other than microfinance, again, it depends on product-wise because our MLAP, which is a cross-sell product to the top end of the microfinance customer, naturally it will align with the geographic distribution of microfinance itself. In terms of commercial vehicle nearly about 35% is from Tamil Nadu and 50% from South and the rest from the West and North. In terms of the new products, more or less they are evenly distributed because even as we start, the products are offered across the locations, so they are fairly evenly distributed. Historically what happened is that, we started in Tamil Nadu with all our branches in TN, and then we started expanding to the other states. So you see a TN weight is high on the old products like microfinance and MLAP. When we started vehicle finance, we had the first few branches in TN, but immediately we had started putting up branches for VF vehicle finance in other states. That's why we see a larger distribution across the rest of the geography. But as far as the new products are concerned, our entire branch distribution already is in place across South, West and North. So any new product that we launch, immediately gets launched in different markets. And so the distribution of these products kind of more wider spread even from the beginning.
Okay. So, sir, broadly, would you agree that about 50% of the loan book, non-micro loan book, will still be in PN, and that is, decreasing over a period of time? Is that the way we should think about it?
What percent you said?
50, because you said MLAP is broadly mirroring the micro portfolio.
Yeah.
Okay.
So that's what I told you. Product-wise, if you take it, this is the distribution I just mentioned. But if you aggregate it, I don't know. I have to find out.
Sure. No problem. Yeah. Thanks. All the very best. Thanks.
Okay, Dhaval. See you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. S. Bhaskar for his closing comments.
On behalf of Equitas Management, I thank all of you for your interest in our performance, and we look forward to your continued interest and participation. Thank you.
Thank you.